So, by way of introduction, I'm Kelly. I'm one of the tax advisors here at Gravita, and I'm delighted to be joined by George Uglow, who is of Evelyn Partners and a chartered financial planner. I can give you all the tax advice about private pensions, but I cannot give financial advice. And that's where it's so great to be joined by George, as he certainly can. So, together, hopefully, we can cover all of the topical things you're thinking about your private pension. So in this session, we'll be looking at the benefits, the tax benefits primarily, where I'm coming from at it, planning points about private pensions and how to use them. But before we kick off talking about private pensions, I just wanted to include a couple of slides about the state pension, because this is really important stuff that I think everyone should be aware of. So the state pension, just fundamentally, you can access it from 66 years old at the moment. That will be 67 years old from 2026, and no doubt it will keep climbing. So when I get there, I'll probably be about 80. But to get a state pension to begin with, you need 10 qualifying years of national insurance contributions or credits. So if you don't have 10 years qualifying for national insurance, you will not have any state pension. You need 35 qualifying years for a full state pension. The full amount is £230 and 25 pence a week, roughly £12,000 per year. And you need 35 qualifying years to get this full amount. The state pension is taxable. It does need to be reported on the self-assessment tax return. If you don't submit a self-assessment tax return and you're in receipt of the state pension, it should be coded into your tax code for tax deducted at source. But just a lot of you will probably be thinking, well, how do I know how many qualifying years I have? So I thought I'd log into my own state pension forecast and just show you what it will look like. I would encourage absolutely everyone to have a look at this. If you literally just Google, check your state pension forecast, you should be able to log in or create a login, and they'll link it through your national insurance number, and you should be able to see this screen. So you can see here that I actually have 10 qualifying years. So I can access the state pension when I come to state pension age. And currently my estimated state pension based on the 10 years is about £67 a week. I need to contribute for another 25 years to get the full state pension. This is quite important, this kind of table on the right hand side. For all of the years, it says full year. If in the last 6 years, one of those years were not a full year, I could still go back and make voluntary contributions to make it count as a full year. So you can buy something called a Class 3 National Insurance contribution. This is a voluntary contribution, it's about £17 a week, but it can fill gaps in your state pension record. Roughly each missing year, if you've got over the 10 years, but then you're still missing years up to the 35, to fill in that year would cost £17 a week, so roughly £900 a year. And it could increase your pension by about £350 per year in retirement. So it would only take 3 years to make up the voluntary contribution you were to make. Anyway, enough about state pensions, but if the only thing you do after this is go and check your forecast, that will be positive. Okay, so on to pensions. There's two main pensions, and in this session, we are exclusively looking at defined contribution. Defined benefit, if you are a regular of watching mine and George's presentations, we have explored defined benefit to death nearly. This is a final salary career average schemes that affect public service individuals. So maybe you're in an NHS, you're in civil service. There's something very topical called the McLeod remedy that has been massive kind of shake up in the defined benefits pension, but we will not be covering that on this course. If you are in any government pension scheme, then please reach out because me and George can definitely help, and we have lots of recorded webinar content on this that you may find useful. But this webinar is exclusively about defined contribution. So, we're talking the money purchase pension schemes. You or your employer make contributions, it goes into the pension fund, it's invested in underlying investments that hopefully go up and increase in value, and then you come to draw that in retirement. So it's a defined contribution private pension. And within defined contribution, we have different classes of pension. So you could have a personal pension scheme. This is something you could set up yourself through a pension provider, and the pension provider would then manage it for you. You could have a SIP, which is a self-invested pension plan. You've got full control over your investments. So you're actually picking your underlying investments, usually kind of for the more experienced investor that, wants to pick and choose what stocks and shares or what it's invested into. Most of us are hopefully enrolled into a workplace pension, something arranged by the employer, and you see these contributions going out on your monthly pay slips. Or you could have a SAS, which is a small self-administered scheme, and these are far less common now, but they're typically small company pension schemes. There are more than those four, but those are kind of the main four that we see. So the key features of a private pension. So you can access from at the moment from when you're 55. This is rising to 57 from 2028, and no doubt, like the personal pension, that age will keep going up. Flexibility on retirement. This is something that George will obviously touch on because this is more financial planning and advisory element. But you've got the opportunity of within your pension pot to either draw it down when you come to retire or buy an annuity. The tax relief on contributions. So up to the age of 75, you can still save income tax when you make contributions. And I've got a few examples of the tax benefits of doing so. It could reduce income for the reinstatement of the personal allowance. So a pension contribution could save you tax at 60% in some scenarios. It could reduce your income from the high income child benefit charge, which gets taken away if you have children and your income goes above 60K. You could make a personal pension to bring that back down and reinstate your child benefits. So some really good tax advantages to be had on contributions, which we'll cover later on in this session. But also on extraction of the pension funds, there's also, tax relief to be had here. 25% of your pension pot up to the lifetime allowance can be drawn tax-free. And equally, when you draw your pension, you're likely to be paying low rates of income tax because maybe you're not employed anymore. So, this is far less tax on extraction as well. Contribution limits, and this is something that we need to watch, and I will go into a lot more detail about this later. Mainly we have these limits around relevant earnings, the annual allowance, and the lifetime allowance. And then the big one is the inheritance tax changes. Probably why so many people are interested in this webinar, because there has been a big change to how pensions will be taxed when it comes to inheritance tax. And that's something that I will touch upon, and then George will be giving examples and to discuss the proposed changes coming in from April 27. So just to set the scene as to the position with private pensions are one of the most expensive tax reliefs in the personal tax system. And they're actually marketed as such. Very rarely do we say to clients, and maybe we should, we rarely would say to clients, are you making pension contributions so that when you retire, you have enough income? What we usually say is, are you making pension contributions because do you know how much income tax that would save you? And that's just where we are at the moment. It's marketed very much as a tax planning tool. And in this graph, this is from the ONS, but the statistics are only up to 22, 23. So that's the most up to date I can do at the moment. But in 22, 23, the gross income tax and national insurance savings from pension contributions cost the government 70.6 billion. So we're talking huge tax reliefs to be had when we're making private pension contributions. The stats aren't released for 23, 24 onwards, but I could only imagine that to grow because I'll talk about some of the allowances in due course, but the allowances have actually got bigger. So this is a huge cost to our government. And it's no surprise that ahead of every budget day, they're kind of saying, they're going to cull some of the tax relief on pensions because it is really, really expensive. And just in terms of kind of where that income tax and national insurance saving comes from, so the big orange segment, this is a breakdown of where that tax saving comes from. And the big orange segment is showing that the majority of that tax relief is from income tax relief on employer contributions to net pay schemes. So that's costing the government £17 billion. Quite worryingly, that really small grey slither is the self-employed contributions, income tax relief for them. And I mean, that is worrying because most self-employed people probably don't think about private pensions enough. So those in employment are getting all these tax reliefs. They're in occupational pension schemes, but the self-employed are only getting tax relief on 0.9 billion, which sounds a big number, but in the context of it all, it isn't. And those are the people that aren't probably funding their pension enough. Now moving on to one of the fundamental concepts that I just wanted to get right from the start. All contributions that you make to a private pension pot are deemed to be net of basic rate tax, even if you pay no tax. So we often say to clients that, we could do an exercise and they'll say, how much can I put in my pension? And we might say £1,000. It's really, really important that you clarify, and also the client is aware that to get £1,000 in the pension pot, you would only need to contribute £800. The contributions are net of basic rate relief. You would contribute £800, and then the pension pot would then add the additional basic rate. So they would add the £200. You don't need to apply for it. It's automatically deemed to be net of basic rate tax. If you pay tax at a higher or additional rate, you would then claim this extra relief that you're owed because they only add the basic rate of tax and you might pay tax at 45%. You would make this adjustment through your personal tax return, so your self-assessment tax return. So when we're doing all of our self-assessment tax returns, we're saying to clients, and hopefully they're telling us, if they've made any personal private pension contributions directly to a fund, because there could be additional relief to be claimed here. And it's something that just absolutely should not be missed, is, tax relief is there to be claimed if you are making direct contributions. So then, if pensions are so great, why don't we just shove everything into a pension pot? So we need to be careful because there are caps to contributions. So these caps are relevant for the amount that you can put in and get tax relief, but which makes them especially relevant because why would you make contributions to a pension pot if you're not getting tax relief? So if you're not getting tax relief, you're better off to just have that money for yourself and not lock it away in a private pension till you're 55 or soon to be 57. So it's really important that these caps everyone knows about them, because without the tax relief, the use of a pension contribution becomes largely redundant. So we'll start with I've got put these in this order on purpose because relevant earnings is usually like the first cap to consider because it's the smallest, then the annual allowance, and then the lifetime allowance. But if we just kind of kick off with relevant earnings, the important thing about relevant earnings, I'll come on to define that in a moment, but even if you have no relevant earnings, everyone can put £3,600 gross into a pension scheme each year. So even if you have no relevant earnings, which I'll define in a moment, so if you've got no earnings, let's say, no relevant earnings, you can put 3,600 gross into your pension scheme each year. And because this is that, if you were paying attention a couple of slides ago, this 3,600 is gross, which means you would only need to make a net contribution of 2,880. So that's the net amount you would actually pay to your pension scheme. They would add the basic rate. You would end up with 3,600. This amount for a child into a pension scheme, they typically would have no earnings, but you could contribute 3,600 gross into the scheme for them. They might be pretty mad because they wouldn't be able to access this money till they're 55. And, if they're a child now, that's probably going to be 65 when they get there. So it's something to think about, but children, anyone can have the 3,600. So then let's say you want to contribute more than that, which hopefully most of us do. That's quite a modest amount to be thinking about a pension. We need to then start thinking about relevant earnings. So beyond the 3,600 gross, we need to be looking at if you have relevant earnings to support a higher contribution. So when we talk about relevant earnings, broadly, this means like earned income. They want to see that you're actually in employment. This is a very hot topic because these rules changed on the 5th of April 2025. Furnished holiday lets no longer exist. They are, or the terminology in tax law of a furnished holiday let, they are now also treated as passive investment rental income, so no longer support relevant earnings for pensions. There are also a whole host of other issues with the abolishment of the furnished holiday let rules. If you run furnished holiday lets, then definitely reach out because something that hopefully you are already aware of, but this is just one of the stings in the tail of having that regime abolished. Investment income, so dividend income and interest income, is not relevant earnings and will not support a pension contribution, and a pension income itself will not support a pension contribution. There's also rules around if you've already started to draw your pension, the amount you can actually put into your pension. I won't go into that now. It is quite complicated, but just broadly, pension income will not support relevant earnings for a further pension contribution. So if we look at Mr. X, just by way of example, Mr. X has rental income of £1,000, interest income of £1,000, and part-time employment income of £10,000. So when we're looking at relevant income, the rental income isn't, it's passive investment income. The interest income isn't, passive investment income. The part-time employment income is relevant earnings. This person has relevant earnings of £10,000, which means that they would be able to support a contribution to their pension scheme of £8,000. They would then get the basic rate relief automatically applied. The interesting in this example is that this individual actually wouldn't pay tax. This individual's, all of their earnings are within the personal allowance. So it's just the fact that they have taxable income. It's not the fact it's actually taxed. So they still get that 20% basic rate tax top up, even though they are not paying tax. If this was Mr. X's own company, they would not be, and the company was making the contribution. Relevant earnings aren't actually a limit for company contributions. I'll come on to that a bit later. But yes, in this instance, they've got employment income. But if this was their own company and they wanted to, the company make the contribution for them, there is no relevant earnings cap. So that sometimes that can be very advantageous. Just by way of another example, you've got Mr. Y. He's got furniture income of 40,000 and interest income of 1,000. Maybe up to the 5th of April 2025, he's been maxing out his pension contributions because he's got all of that trading income from furniture lets. But from the 5th of April 25, no longer will furniture letting income support a pension contribution. So in this instance, Mr. Y actually has no relevant earnings and he would be subject to the minimum 3,600 gross. It is highly likely now we might see some clients that aren't aware of the furniture let changes and therefore they're making excess contributions. If this happens, there is an obligation to inform the pension provider by either the 5th of April, so the end of the tax year, or 30 days after the event, whichever is sooner. The pension fund should then repay the 20% it's claimed from HMRC back to HMRC. It's not something that we could adjust on the tax return. We say to clients, you need to contact your pension provider and tell them, because there could be lots of punitive consequences if not. So I mentioned earlier that this relevant earnings isn't a cap if the company is putting money into your pension for you. So which can be quite beneficial if you're an owner managed business, it's your own company, you're not drawing out salary because maybe you're taking dividends and therefore you have no relevant earnings. Get the company to make a pension contribution for you and then you're not capped by relevant earnings. So there is no cap for employer contributions from the company. We do need to consider the annual allowance in this scenario, which I'll come on to next. The company pension contributions can be very tax lucrative because you also get corporation tax relief from the company. And there is no employee or employer national insurance to be paid. And that's a massive one. Employer national insurance is now 15%. So real tax savings to be had here. To get the corporation tax deduction as well, I must note that the pension contribution has to actually be paid. So it can't be accrued for. When we do corporate tax returns, we always have to do an adjustment if we do the corporate tax return up to 1st of December, but the pension isn't paid to the 1st of January, let's say, we have to adjust for that. So on the face of your corporation tax return, you probably see some strange adjustments for add back of pensions. And it's basically because you can't have tax relief unless they are paid. Just a note of warning, whilst these are great, HMRC may question large or irregular pension contributions made from a company because they still need to satisfy the wholly and exclusively rules, which is the rules to get the corporation tax deduction. We usually find if you're a director of the company and therefore you have lots of responsibility, you have legal responsibility for the company, it's a job in itself being a director, so it's usually justifiable to have quite large pension contributions. If you're not a director of the company, it can be quite difficult to get inside the holding exclusively rules, but definitely something to come and have a discussion with us about if you do run your own business and can have flexibility to put money into a pension. So just by way of example, let's say we have a company that's made a profit of £100,000. You draw a salary up to the personal allowance and then you take dividends. If you were to then put money in a private pension outside the company, you would only have relevant earnings of the 12,570. However, the company could put £40,000 into your pension. So that's great. The contribution is within the annual allowance, which I'll come on to next. And your corporation tax bill is reduced by £10,000, being 25% of the pension. That's an oversimplification. If you are kind of privy to corporation tax rates, we now have a tiered rate. So you could actually be saving tax higher than that because there is an effective rate at 26.5% that some companies pay, and there's no personal tax or NIC charges for you. It's a great tax efficient way of getting money out of your company, reducing your corporation tax bill and not incurring any income tax bill. So that kind of covers off relevant earnings, and we'll now move on to the annual allowance. The annual allowance is basically the maximum amount you can put into your pension across all schemes and get tax relief. When we say across all schemes, here we need to consider your occupational schemes. Are you making contributions as an employee, as an employer, any personal schemes you have? So all of your pensions in the year are governed by this one annual allowance. It's not necessarily a cap, but it's the limit that you can only get tax relief up to. And as I said before, if you're not getting tax relief, largely erodes the benefits of using a pension. The standard annual allowance now, it changed in 23-24, is £60,000. So each year you could put in £60,000 into your pension pot and you would be within the annual allowance. If you have high income, and I'll come on to what the definition of that is, your £60,000 can actually be tapered down to a minimum of 10,000. So if you have a high income, the 60,000 could actually be tapered or reduced all the way down to £10,000. So you want to make sure that you're not falling into those tapering rules. There are things we can do to make sure that you're not if you come to speak to us. Annual allowance has this 3-year carry forward rule. So essentially, you've got your annual allowance, which is now £60,000, but any unused annual allowance in the prior 3 years, if you were a registered member of a pension scheme during those 3 years, you can carry forward any unused allowance, which can be really, really helpful and play a massively important part in planning pension contributions because it can allow significant payments to be made periodically without triggering an annual allowance charge. Let's say in this example, in 24-25, I made £120,000 pension contribution. The annual allowance in 24-25, as we've just established, is only £60,000. I've gone over that by £60,000. So I should have a tax charge at my marginal rate of tax. I pay at the additional rate. 60,000 at 45% should be my tax charge. However, what I can do is I can look back to the prior 3 years and say, well, I didn't actually use all of my annual allowance in 21-22, 22-23, and 23-24. I can bring forward £32,000 worth of unused allowances from the prior 3 years. So in fact, I've actually managed to save an annual allowance charge on 32,000 at 45%. So around £15,000 has been saved here by being able to recycle some unused annual allowance from the prior 3 years. On all of our clients, or on all of my clients that are affected by tapering or close to the annual allowance limits, this table I have going back to 2015-16 as I've kind of been looking at their carry forward capacity. In practice, on all clients kind of close and being affected, we have an Excel spreadsheet that basically kind of takes us through each year to make sure we're not missing this as a really, really valuable carry forward capacity for the annual allowance. So tapering of the annual allowance. You noted earlier that I said the annual allowance is 60,000, but you could be in a position where it goes all the way down to 10,000. And this is largely if you have high income. And in order to be classified as high income and into the tapering rules, you have to pass 2 tests. I say pass as if it's a good thing. I mean, it's a good thing that you've got high income, but it's not a good thing if you're into the pension tapering rules. In 2020, the threshold income test was actually set at 110,000, and you can see now it's actually at 200,000. It was set at 110,000 in 2021, and there was a lot of pressure from NHS consultants who are massively affected by annual allowance tapering, because essentially they were doing extra shifts during COVID and there was no incentive to do so. They would go over the 110 threshold and they would lose all of their annual allowance. So an extra shift, in the COVID pandemic could cost them £50,000 worth of annual allowance if it gets tapered from 60 to 10. So that's why in 2021, under a lot of pressure from the NHS, it moved to 200,000. So essentially, the threshold income test, we look at all of your income chargeable to tax, take your taxable income off the tax return. It's a bit more complicated than that, but let's just oversimplify it for now, and deduct your gross pension contributions. If that is above 200,000, you have passed test 1, and we then look at the adjusted income test. So the adjusted income test is then looking at all income chargeable to tax again, but this time we add on occupational or employer contributions. And if that's above 260,000, your annual allowance reduces by £1 for every £2 your adjusted income is above the 260,000, down to the minimum of 10,000. So if your adjusted income is 360,000 or above, you'll be down to the minimum of 10,000. So let's look at Mr. Z. Very inventively named here, but let's say he's a business owner. He's a shareholder and director of his own company. He's seeking retirement very soon, which is why he's really seeking to max out his pension contributions. And he's also just recently had an inheritance, let's say. So he wants to put all his available cash into a pension, get the income tax relief, and he's quite close to pension age, so he can then be drawing on it anyway. You might think this is a typo, that total pension input is 150. I've deliberately done that to see if people were understanding this concept, that the personal pension contribution, that's 40,000 net, gross, that's 50,000. So add them together, 150 into pensions. So he's got a salary of 251 and he's got a total pension input of 150, looking at his employer and his personal contribution. So first, let's apply threshold income test. Total income minus his gross personal pension contribution. He's at 201,000. He's exceeded the 200K. He's passed test 1. We have to go on to the next test. I think the thing that we would find frustrating in this example is if he actually came to talk to us in year, because this test is applied in year, we can't retrospectively go back and change it. We would have actually probably said to him, you're only £1,000 above the threshold income test. You have a pension problem, but actually if you put an extra £1,000 in your personal pension, you'd be below this test and you wouldn't be tapered. So it sounds a bit counterintuitive, but in some instances, making an even bigger personal pension contribution can stop you removing the taper. And this guy is going to be tapered quite heavily. Whereas if he had put in an extra 1K, came to speak to us, we could have saved his entire annual allowance. So then we move on to the adjusted income test, because unfortunately he has gone over the threshold. We look at all income chargeable to tax plus his 100K in his employer scheme, and he's got a total adjusted income of 351. So he is in taper. I'm going to rattle through this because I know George probably wants to get all of his slides in as well. So just the fundamental concept here is this guy is tapered. He's unfortunately gone from having a 60,000 annual allowance down to 14,500, and his pension tax charge is £60,975. And this is what he has to pay via his self-assessment tax return. But maybe Mr. Z was a genius and he did seek our advice, and maybe he had unused annual allowance capacity to bring forward from the prior years. But we can do that calculation and that modelling to, find the real optimal amount of pension input, because it's got to be done in year. This just demonstrates where you've got to put it in on your tax return. This is the lifetime allowance really quickly, because the lifetime allowance was actually abolished in the budget in 2023. However, I've still put it here because it's still relevant for when you come to draw down your pension and the tax-free cash you're allowed to take out. The tax-free cash is limited at 25% of the £1,073,100. So the lifetime allowance is no longer relevant in terms of, exceeding the amount you can save towards your personal pension, but it is relevant when we look at the amount of tax-free cash you can draw. I really want to kind of talk a bit in detail about this because this is something I see far too often, and people are genuinely missing out on tax relief, which I do not like to see. Employees' pension contributions are so misunderstood and confused. There are two employee pension schemes, net pay and relief at source, and they work very differently. If you are on a relief at source scheme and you are a higher or additional rate taxpayer and you are not claiming additional relief or a self-assessment tax return, you are missing out on money. I don't know if you would know whether you're on a net pay or a relief at source scheme. You could be on a salary sacrifice scheme, and I'll come on to that next. The reason I'm not including salary sacrifice scheme here is because it isn't an employee pension scheme. You are contractually giving up salary for your employer to then make the contribution on your behalf. And that is the best tax scenario. But I'll cover that next. But let's say you're either on a net pay or a relief at source scheme rather. They are not helpfully named, and you will not be told which one you are on. I had my payroll team knock up 2 example payrolls under each scheme and have really helpfully named them Miss Jane Net Pay. I know she's on a net pay, but you will not have this luxury when you have your payslip. On my screen, the payslips are so small I can hardly read them, but I hope that they're not on yours. But if I just talk you through the net pay, so the net pay, this Jane is on £100,000 salary, which works out to a monthly amount of the 8,333. You can see that she's contributing 5% of her pension into a net pay scheme. So that net pay pension contribution is taken off before tax is applied. So if you look at the year-to-date taxable pay, that is 7,916. The 8,333 minus the pension contribution. Miss Jane net pay has had full tax relief. She doesn't need to do anything else. She's had full relief because the tax has been worked out after the pension contribution has been deducted. And she does have to pay national insurance, a bit of a different story, but she's had full income tax relief here. Happy days, has to do nothing, is on a net pay. Unfortunately, Miss Amy Relief at Source is on a Relief at Source scheme. And you'll see that even though she's putting 5% into her pension, the pension contribution has now moved over to the right-hand side of the payslip, which is usually when I look at the payslip, that's the first thing I see, is if it's on the left-hand side, it's usually okay. If it's on the right-hand side, you're usually at Relief at Source and you might have to do something extra. But you can see here that even though I asked my payroll team to do this payslip and envisaged that 5% was going into the pension as the employee contribution, only £333 has been taken. This is because it's a relief at source. The pension scheme's automatically adding 20%. So 5% will still end up in Miss Amy Relief Source's pension, but it must be 4%. Only 4% is actually taken because she gets that additional 20%, which works out 1% added to the pension scheme. However, she is then taxed on the full £833. So she's had a 20% basic relief in the pension fund, but she's taxed on it. If she pays tax at the higher or additional rate, she should be claiming extra relief on her personal tax return. And the amount of times that is missed is absolutely insane because we would never know from the P60. The P60 would not tell us which scheme she is on. We would be relying on the client to either give us their March payslip, which we ask as default now. The March payslip still doesn't shout which it is, but we are specialists in this area and we can deduce. The other takeaway is check your state pension forecast and also seek what pension scheme your employer is operating, because if it's a relief at source, you are due extra relief if you pay higher or additional rate tax. So that's all I'm going to say there, but something I feel quite passionately about on missed tax relief, and people are just completely unaware, and unfortunately it's unlikely your payroll team will tell you. Salary sacrifice, really quickly looking at this is the best of both worlds because this is not an employee contribution. You are contractually giving up some of your salary for your employer to make it on your behalf. And this is a tax-free benefit in kind. So you pay no income tax on it and you pay no national insurance. So it's the same as net pay in terms of income tax, but there is also a national insurance saving to be had here. And on all circumstances, This table just summarises this individual's on 100,000, wanted 5% in their pension. Take-home pay is highest under salary sacrifice. But the relief at source must do a personal tax return to claim their additional relief, because you can see their take-home pay is well behind the other two. Really quickly, just putting this on here, added this slide this morning because this is interesting and hot off the press to me, maybe not to you, but HMRC published a research paper yesterday evening to understand attitudes towards employers and salary sacrifice, because there are so many rumours that the tax benefits of salary sacrifice are going to be taken away. And all I did was Google salary sacrifice for pensions this morning also, and all of those articles came up from all those newspapers suggesting that it's going to be taken away. We're running out of time very rapidly, but really quickly, pension contributions. This example basically illustrates how a pension contribution can save tax at 60%. Person X is earning 120,000. They've had their personal allowance tapered away because they're within that kind of toxic tax zone of being over 100,000. Essentially, if they contributed £16,000 net to a pension, they reinstate the full personal allowance, save income tax at £8,000, and they'd end up with £20,000 in their pension pot. They're saving tax at 60%, and that's one of the massive income tax advantages of a pension. It really can get you out of a pickle in terms of reinstating your personal allowance. Also, the same for high income child benefit charge, and there are multiple others. A pension contribution can reinstate income for you. Other benefits, growth within a pension is tax-free. You don't pay income tax or capital gains tax within a pension pot. 25% is tax-free on drawdown, subject to the lifetime allowance. Employer contributions can be a tax-free benefit and a really efficient extraction from the business because national insurance savings, corporation tax relief, etc. IHT efficiency, I'll leave George to kind of go through the rules here because I've already run out of time. You can no longer will pensions sit outside the estate for IHT purposes. In recent years, pension pots have been marketed as tax planning tools for the transfer of wealth for IHT and without a charge. However, missing out on their intended purpose, which is to fund retirement. So it isn't that much of a massive surprise in the budget. We saw them potentially from April 27 being brought back into the estate. I won't go through this slide because I know George is going to cover it. So I'm going to hand over to George. And sorry, I've gone over my time.
Morning, everyone. Thank you for joining. Just a quick one before I dive into this. We do have a Q&A and chat box here in front of us. If you've got questions, please send them through. We can see them here and we'll deal with as many as we can at the end. But I can see a few have come through already, so thank you for sending those through. I'm just going to dive straight into it, carrying on from what Kelly was saying in relation to the proposed IHT changes following the budget. So just to be clear, this hasn't been confirmed yet, still in a consultation period, but essentially they're proposing that private pension funds and a few other things could be brought into the estate from April 2027. So at the moment, pension funds, private pension funds, are outside of the estate for inheritance tax purposes. So what we've seen is a shift from people saving or using a pension to save for retirement and instead using that as an inheritance tax planning tool and essentially passing that down through the generations. So the government have looked at that and said potentially they are going to bring that into the inheritance tax regime from 2027, but the consultation's still ongoing. There's a lot to work through and there's no real guidance on that at the moment, but it has been proposed. But I think what we were trying to highlight today is that pensions still remain a very tax efficient way to save for the future, especially for retirement. You get tax relief on the way in. There's no tax to pay on income and capital growth within the pension wrapper. And then when you're drawing money out, a portion of it is tax free. And if you're looking at it on a year-on-year basis, you can structure the income. So you're trying to maximize as much as possible from that pension. But just to give you a little bit of an insight on what the changes could be, I've got an example here of the proposed changes. So we've got here husband and wife, age 58, very good health. They've got 2 adult dependent children or non-dependent children, good. And this is an overview of their current assets. They've got a main residence valued at £800,000. They've got a buy-to-let property at 200,000. They've got cash ISA, 120,000, and they've got a significant pension over £2 million currently outside of the estate for inheritance tax purposes. So their total estate, if you're including the pension, is just under £3.4 million. The top box is looking at where we are currently, our understanding of current legislation, and the box below is the effect that the budget or the proposed changes could have on the inheritance tax position of the pension. So I'll run through the top box. We've got a total estate just under 3.4 million. We've got taxable assets of 1.12 million because the pension is currently outside of the estate. This married couple have two nil rate bands to use of totaling £650,000. They've then got resident nil rate bands of 350,000. So the potential amount left for beneficiaries after tax has been deducted, including the pensions, is about 3.35 million. If the pension were to be included within the estate, in the second box, we can see that the taxable assets has jumped from 1.12 million to 3.398. Because this is over £2 million, the residence nil rate band is then removed, and the amount subject to IHT is much higher. So the potential difference that the budget could make is a total tax burden of over £1 million on second death. Now, this is not yet confirmed. It's something that's being looked at. We're highlighting it because there are lots of things that you can do, which I'm going to cover now. One of the easiest and simplest ways to prepare for inheritance tax is to spend more money. That's the enjoyable one. Spend more, reduce the size of your estate. Other things that you can do, you can gift. So you can make gifts to individuals, you can make gifts to trusts. There's different gifting allowances that you can use annually that would enable funds to be outside of your estate immediately. What a lot of people are looking at now are the use of insurance policies. What you can do is consider something called a whole of life policy. This is a policy that runs for the whole of your life and guarantees to pay out a lump sum on your death with the purpose of covering an inheritance tax bill. People will consider the use of trusts, reviewing the will to make sure that everything is included in there that should be included. And there are some specialist investment products with favourable tax treatments. But the key message from here is there's no one size that fits all. It's very individual, and it's looking at your individual circumstances to look at what solutions are likely to be right for you. However, at the moment, this hasn't been implemented yet, and a lot of the conversations that we're having is just discussing, what is the inheritance tax liability? Do you need to make any changes? Because you might not need to. It's just looking at it individually and getting to the bottom of it. However, I think we're probably going to do a separate session on inheritance tax. I'm just going to pull this back to private pensions. So pension consolidation, this is probably one of the most common questions that we get asked as financial planners. So I've got a series of pension pots. Should I put them all into one? So let's start off by looking at the advantages and the potential disadvantages of doing that. We're focusing on defined contribution pensions here. One of the advantages of having all of the pensions in one place, easy to administer, you know where everything is, you've got peace of mind. Potentially having a larger value with one provider will reduce the ongoing costs, because normally it's sort of an economy of scale. The charges are tiered. So in the background, if you've got a larger fund with one provider, potentially that reduces your ongoing costs. Potentially, you've got a pension that's been set up by an employer. It might have a limited range of investment options. So moving to another pension could widen that pool. So you've got a wider range of investments to choose from. And you might have increased flexibility as well, because now modern day pensions, they've got the full range of access options. You can draw them down in different ways and you can use them in different ways. So you may benefit from additional flexibility. However, disadvantages, you may lose some valuable guarantees within the pension plan. So each pension plan is slightly different to the next one. They might have a different retirement date. They might have valuable guarantees within them, such as an enhanced annuity rate, so a higher value that you can get on the open market. So if you transfer that plan, potentially you lose that benefit, which you may not even know is there. Another one, Kelly's mentioned the tax-free cash that's available within a pension plan. Usually that's 25%. However, in previous pension schemes and older pensions, that could be enhanced. and it could be greater than 25%. So if we see that, then we want to make sure that you're keeping these guarantees and benefits. Just transferring them from one pot to another, you could potentially be losing out on these things that are within the terms and conditions. The other point to mention as well is that some pensions are very, very low cost. So if you were transferring from one to another without looking what's under the bonnet, then potentially you're moving to a scheme that's more expensive. So there definitely are advantages, but there's also disadvantages that need to be looked at before taking any action. So in terms of the actual process that we would follow, the first stage is, let's say we've got 4 or 5 pensions to consider. The first thing we would do is write to each of those providers, get us to send us all of the terms and conditions so that we can look at each one individually. Because the starting point is always, if you don't need to move, don't move. Let's look and see if you can achieve what you want to achieve with what you already have. And if you can, then we can make a recommendation. So what we're looking at is, what are the ongoing costs within the pension plan? What level of risk are you taking? Does it fit with the level of risk that you should be taking at that point? What's the performance of those investments? And within the pension fund that you already have, do they have other alternative options that might suit your needs? Are there any valuable benefits or guarantees, like I've just mentioned there? So enhanced annuity rates or a higher level of tax-free cash. Are they there? If they are, then we'll be looking to probably keep those plans unless there's a reason not to. One of the most important as well is, can the pension be accessed how you want to access it? Because you may be thinking, I've got my pension here, I'm planning to maybe draw down on that in a few months' time, but that provider may not offer that facility. So it's just making sure it actually does what you want it to do. So the outcome of a pension review, if we were looking at different plans and considering whether or not to move them into one, could be that everything looks fine. You don't need to make any changes. Low cost, good investment options, everything's absolutely fine. Option 2 might be that, okay, of these 4 plans, this one seems to be the best value with the best investment options. You could potentially consolidate into one that you already have. Option 3 may be, okay, there's no guarantees, the investment range is very inflexible and it's high cost. Let's recommend a new plan and start to work together moving forward from there. So it really comes down to individual circumstances and what you're looking to achieve, because when you're putting a retirement plan together, where the pension is just one piece of that puzzle, we need to look at income and expenditure, savings, cash balances, and build it into a plan rather than looking at one piece of that plan in isolation. But it is a very important piece to make sure that you can access income as and when you need it. So when it actually comes to drawing from a defined contribution pension, so you're at retirement now, you want to consider your options. Since the pension freedoms were introduced, I think it was 2015, where they said, okay, you don't have to use a private pension to buy an annuity anymore. You can now access it in a variety of ways. These are essentially now the options that you have. So you can take your lump sum within a private pension and convert that into an annuity, which is a guaranteed income. So let's say, you take £500,000, you take that to an annuity provider. They say that they will pay you X amount of income for life for the rest of your life. And within the annuity itself, there's lots of different options that you can include. So you could have one that's inflation proofed, so that income continues to go up. You could have one that has guarantees within it. You could have one that protects some of the value of the annuity. So if you pass away in the first few years, your beneficiaries would receive a portion of that lump sum you've used to buy the annuity back as a lump sum. So annuities are still a very good option to consider. Rates have improved over the last few years, which is positive. So we are starting to see a lot more annuities. The other option is uncrystallized funds pensions lump sum, which rolls off the tongue. We would call it UFPlus, but essentially this is just taking out chunks of pension as and when you need it. So I want £10,000 now, take that out from the pension pot. 25% of it would be tax-free, 75% of it would be taxed as income. The reason you would be looking to use this option is normally if you're sort of straddling 2 different tax bands, it might be that you don't want to push into higher rates of tax. So you take little bits of pension out to keep you as a basic rate or higher rate taxpayer, depending on your personal situation. The third option is flexible drawdown. So what we've seen a lot of in previous years is you might take out your 25% of tax-free cash, use that, spend it how you want to, and then leave the remainder of the fund invested for the next 20, 30, 40 years, and then drawing down on that fund and maybe taking a regular income, similar to the income that you might have received when you were in employment. But in reality, most people are looking at a combination of all of these things, and it's just getting to the bottom of which one is the right one for you through a series of conversations, essentially. So I think it would be helpful for us to look at a bit of an example of what we would do if we were trying to put a retirement plan together. Here we go. So I've got an example here. Common question is, do we have enough to retire? So this is how we would approach that situation, essentially, to try and put a plan together. So husband and wife from earlier, they now want to retire in the next couple of years. They are targeting an income from all sources of £55,000 per annum. They want to make a gift of £50,000 to their children for a house deposit. And they also want to take a nice holiday every year. So they've set a big budget, £10,000 per annum. Kelly's had a look at their state pension record, and we know that they've got a full state pension available to them, which is going to give them another guaranteed source of income. They've got their main residence, they've got a buy-to-let, they've built up significant cash savings, they've got stocks and shares ISAs that are invested, and they've got two defined contribution pots. The husband's built up £500,000 and the wife has £800,000. So two really healthy funds. The first thing we would typically do in this situation is convert this into something that looks like this. What we want to do is try and put together a visual representation of what the financial position might look like in the future. So what this chart is showing us is, if we retire at age 60, how long would all of our assets last if we spent £55,000 a year? And where would we draw that income from? So we can see in the first year, they're spending a little bit of cash, they're spending down on investments using ISAs, and they've got their pension assets along the bottom there. But this is a best case scenario. So what we need to do is overlay a few stress tests. Okay, so it looks like we can spend £55,000 a year with the assets that we have. But what happens if my spending is wildly more than we expect? What happens if we want to double our holiday budget? What happens if somebody becomes ill? How are we going to pay for that? And our job is to stress test this to make sure that not only is there enough for retirement, but also there's sufficient contingency to be able to plan and prepare for any unforeseen circumstances as well. So it's really about trying to give a visual representation, taking numbers from a page, and forecasting sustainability over a long period of time. And when we're looking at something like this, we would want to tailor it to get it as specific as we can to your position, because underneath here, there's a lot of underlying assumptions around inflation, around investment growth. So we need to have conversations in those areas to make sure this is as specific as it can be, to try and give you a representation of what retirement might look like. And if there was a potential shortfall, we'd then be looking at, what do we need to do to plug that shortfall? Do we need to make more pension contributions? Do we need to work part-time? Do we need to downsize? There's lots of things to consider that will go into building a plan like this. However, in this situation, this is what we did. So this couple had rental income of £10,000. They both had a full state pension of £12,000. The husband, after conversations, he was a low risk investor. He didn't want to be invested anymore. So he took his pension fund and purchased an annuity that was paying in an income of £15,000 that was inflation proofed. So all that secure income coming into the household. The wife, on the other hand, she was a bit more comfortable with investment risk and wanted to remain invested for the longer term. So she went into flexible drawdown and started drawing £30,000 per annum from her pension pot. So £30,000 of income coming into the household. The remainder of the fund is still invested in the background. So if she wanted to, she could increase that income, she could decrease it, she could turn it off, and then start to take lump sums in the future. So there's lots of flexibility within that. But they also had their cash and their ISAs that they could dip in and out of to top up their income. But this is just to give a bit of an example of how we would assess a situation, try and build a visual representation, and then we look at what solutions we need to implement to actually meet that income target. So in this case, we've looked at an annuity and we put a drawdown plan in place. In terms of the process that we follow, the first stage is getting to know you. We would normally have an initial meeting talking about where you are now, what it is you would like to achieve, talking about what assets, income, and expenditure you currently have. We would then go away, write to each of the relevant providers, analyze all of the detail that you've given us. We'd ask you to complete risk questionnaires. We would take all of that and then come back to you with a recommendation report, essentially saying, this is where you are. This is what you would like to achieve. These are the steps that we think you should take to be able to achieve those goals. And that would be the second stage. If you were then happy and we were in agreement, we would then move forward and implement the advice. So liaising with any relevant providers, setting up any new investments or tweaking any existing investments that you have. But the most important part of any plan is making sure that it's reviewed over time. So we then, if you wanted to, would meet on an annual basis. We'd look at what you have actually spent. We would look at what is actually coming in, and then make sure that the plan is on track to do what you need it to do, so that each year you've got the income that you need and it's structured as tax efficiently as possible. And then from here, we would then move forward to start looking at things like inheritance tax planning, and also the next life stages, helping children, whatever it may be. But that is essentially a whistle-stop tour of pension consolidation and how we would put together a retirement plan. But there's no one size fits all. So if there are any specific questions, please send them through and we're always happy to answer them.
So questions have been racking up whilst we've been through that. We have gone over time, but we'll just try and rattle through a few questions. I will move this slide onto the final slide. And actually, if you do have a question and we can't get to it, that should lead you directly to my profile and George's profile, and feel free to email us directly. We'll want to hear from you. So that's fine. But just looking in the Q&A, so I won't read out names, but if I have a subcontractor working for my company, can I pay the subby by contributing to their pension scheme? Yeah, you certainly can. I guess to actually answer that question properly would depend on whether you're engaging with the subcontractor on their PAYE, or are they acting for you on a self-employed basis. Also got another question saying, what is auto enrollment, which links into this a little bit, because if they're employed by you and on PAYE, and you're paying them more than £10,000, you actually have to sign up for auto enrollment for pensions. It was a government initiative that was introduced to help people save for retirement and set up occupational pension schemes. If you have any employees that are being paid more than £10,000, you must set up an occupational pension scheme for them. This is known as auto enrollment. The employee could choose to opt out, but it's the fact that you actually legally now have to provide them with that option. Does the TFC
Yeah,
cash?
I'll do this one. So there's a couple of questions in here about tax-free cash. I'll just cover off how that works now. So Kelly mentioned that the lifetime allowance had been abolished, which it has, but what they've introduced is a cap on the maximum amount of tax-free cash that you can have in a lifetime, which was 25% of the previous lifetime allowance. It's about £268,000. So you've got £268,000 potentially that you can accrue in a lifetime. If you've already taken money from a defined benefit scheme, the tax-free cash that you've drawn from there would be deducted from that allowance. So if you've got a private pension as well, potentially you can still take some tax-free cash out if you've got allowance remaining. If you do have a defined benefit scheme, an advantage of having a private pension, if you take the tax-free cash from the private pension first, in some cases that can give you more tax-free cash because you don't have to give up as much income from the defined benefit scheme. That's quite specific. So if you want to go into that in a bit more detail, very happy to do so. In terms of the tax-free cash that you can draw, it's not only once. So if you've got different pots, if you've got a pot of 100,000, a pot of 100,000, it's 25% of the total pension up to a maximum of 268,000 in a lifetime. So if you draw some out and then carry on paying in, you could still have the option to draw some out again.
Yeah, so it is looked at combined DB and defined contribution schemes. Yeah, great. Presumably most auto enrollment pension schemes, e.g. Nest, are relief at source schemes. Yes, I believe Nest is a relief at source. I'm
Yeah.
not into the specifics of the payroll, but the relief at source, so Nest are applying that 20%. That, even though I've just said all the negative things about relief at source, because you need to actually claim additional or higher rate tax relief at source can really help those individuals that aren't actually paying tax because maybe they earn just under the personal allowance. So they would benefit from the automatic 20% top up, whereas under a net pay, they wouldn't because they're not paying tax. So the fact that it's come out before tax doesn't help. So there is recently something that's coming in to fix that. But it wouldn't surprise me if Nest, which is a government supported scheme, do relief at source for that exact reason. It depends on pension provider. I can remember asking our payroll and they just have a mix of relief at source, net pay, or salary sacrifice. Yeah,
See how much tax would the beneficiaries of a pension fund have to pay when they draw money out of the fund. So there's two things on this. So currently, it's based on when that person passes away. So at the moment, if someone has a personal pension fund, they pass away before 75, that pension fund can be passed on tax-free to the beneficiaries. After 75, the individual who receives the fund would be drawing out income at their marginal rate. So the issue that we might be falling into with the proposed changes to the inheritance tax rules are that if someone passes away after age 75, the pension fund could be taxed at 40%. And then the beneficiary, if they're a higher rate taxpayer, they could be drawing out 40%. So we could be falling into sort of a double tax trap. But a lot of this consultation is still ongoing. The changes are proposed for April 2027, and it's not yet clear when further guidance will be available. I was on a talk yesterday in relation to this, and normally when there's a consultation on pensions, there's around 100 responses, and I think they've had sort of 7 times that amount. So I think it's going to take a little time to work through this. So at the moment, the guidance is unclear, but potentially could be falling into a position where the beneficiaries are paying tax and the pension fund pays inheritance tax as well.
we'll answer a couple more, but I also just want to say our marketing team are messaging me saying that we'll be following up with the recording of this webinar. So if you do have to drop off, we will be following up with the recording that will be available this afternoon. I've got one here that says, if you think you are due unclaimed tax relief from previous years, what can I do? Well, you could do an overpayment relief claim. So we could go back 4 years. If you go back, you see you're on a relief at source, you haven't claimed tax relief when you should have, contact us. We can help potentially go back 4 years and reclaim that underpaid tax. We could look at that for you. I know we have some overseas contingent here, and I can see a couple of questions about transfers of overseas pensions. Because that's so specific, I won't go into that now, but there is a qualifying recognised overseas pension scheme, and it's an election, and it can essentially mean if it falls into that, you can move your UK pension overseas without a charge, and you wouldn't have to take it all as a lump sum. You can, subject to local law, but we can definitely pick that one up and your other overseas questions at a different point. Any other ones you want to pick up, George? Or the attendees are dropping rapidly, so people are probably going, so maybe we'll...
I think we're pretty much there, to be honest. How will making personal tax contributions stop me losing child benefits? So again, this one's quite specific, but just going back to what Kelly was talking about, if you make a personal pension contribution, it affects your net income. So if you've got income of say £55,000, if you make a £5,000 pension contribution, that pushes your income down to 50,000. So when you're going over that threshold, and this works for 50,000, 100,000, 200,000, pension contributions have the effect of pushing your net income down. So it will depend on your personal position. The best thing to do is reach out and get into contact. We can go into more detail on that. But just
Yeah.
a big thank you to everyone for joining this morning as well. We appreciate your time.
Yeah, perfect. And look out for a potential IHT inheritance tax webinar to follow this one up. Thank you all, and we'll make the recording available.
Thank you.